just keep doing it, or die trying. I don't care about optimism or pessimism. Fuck that, we're gonna get it done.
So we're good. We're on the beach. Salute.
Yo, I'm at the beach too. Here we have a lake, and over there, like the mountain.
Beautiful. Here, I'm with there's some ducks. You see these ducks? And then here I have this like lake.
Nice.
Lake Como.
Lake is life.
Well, mine's not like yours, but it's okay.
Make me cry.
Why is that?
No, that's the sun cream coming to my eyes.
I thought you were thinking
It's
about
Palantir dropping.
Yeah, I thought you were thinking about your Palantir bags.
Everyone is leaving, going for snowflake.
But you know what? I want to make it clear, and actually, we just have it written. I even messaged Chris, and I said, like, I respect his decision. And at the end, you know, we're all individual investors, and everyone's responsible for their own capital. So nobody owes anybody anything in terms of.
Absolutely. Like, for instance, for me, it's helpful hearing for Sasha, because I know that he has reasonable points. I know those points are wrong because I make better due diligence than him.
Yeah.
So by hearing his points that sound reasonable, but knowing that I can go against his points in a rational way, that actually reinforces my thesis. The problem is when you go in the echo chamber and you don't test your own hypothesis. Maybe I'm wrong and Sasha is right, but his reasoning to me is not enough to make my thesis wrong.
But you know what? The major point for Sasha and Chris is that they're both not in love with the CEO. So like you said, on that alone, then you can't even blame them. Like, I love, the temperament of the CEO.
I mean,
and
you can not appreciate the CEO only for a company that is already established, has no major changes. Like, imagine you invest in Coca-Cola, you don't fully appreciate the CEO. You can live with that. I mean, you focus more on the business side, like on the cash produced, the dividend. If you're that kind of investor, you can even stay without really liking the CEO. But for a company like Palantir, that is like in the middle of heavy, important decisions, or you embrace the fact that there's a vision and the CEO is the person that brings you to that division and you fully embrace it. If you have doubts, no matter what, you will suffer because you will not see the good in the things. That doesn't mean that we need to trust blindly what Carps does, because he's not perfect. Of course, he makes and he will make many mistakes. But basically, with Palantir, we bet heavily, as we mentioned many times, not only on the business model, but really on Carp and Carp's ability to select people who are like him and complete him to make Palantir better. We are investing more and more in the people right now than in the business per se, because the business per se is yes, cash flow positive, but it is the people that actually create the business. So we invest more in the people building the future business, and we really need to have trust in what the management does. If we don't trust the management, I mean, even Carp said that's the point he always made from the beginning. If you are not aligned, go somewhere else. There are probably many companies that are way easier. Maybe short term they are much better investments. If you're into a company like Palantir, because you embrace, you see a bigger picture than what currently we see right now.
Exactly. Yeah, I remember when Carp said that. You're right. Now it rings true. Now we're seeing that into action, right? Well, like personally with the people that we know, they're not on board, which is fine. They don't have to be on board. I see their point of view. I mean, I don't personally agree with it, but they're allowed to it. So, anyways, so all good. Like I said, it's great to have the community on the socials, but we just have to be careful to keep the respect and the love. Not go crucify him when if someone decides to leave.
Same point with Sash. I mean, for instance, it's important to understand the other opinion. I would listen much more closely to Chris because he has expertise from inside, like both healthcare and IT. He speaks with many people inside, so the criticism Chris can make is worth 100 times the criticism of someone who just complains about the CEO when he should just look at the crazy assumptions he had from the beginning. Because that
Exactly.
was the problem. Having a reality check that those assumptions were completely detached from the reality. If a company guides for 30% growth and you start modeling 50% growth on the revenues with crazy margin expansion, no
Yeah.
dilution counted, I mean, who's to blame for? The company or the wrong assumptions?
For this Q2, I don't remember getting an update on their operating margins. Did it get better or worse?
They got worse, but still around 20%. So basically, how I see it is like when they are below the 30, it's because they are getting more clients. Because the more clients they get, the more they have to pay for the pilots, the marketing expenses. So it's not a worrying sign. It's a worrying sign if that is not combined with new clients. Imagine we start having margins at 20%, but no clients coming in, or like two clients. That would be a problem. But for a SaaS businesses like this, it's always a balance between revenue growth and free cash flow margin. If the free cash flow margin compress, but then in the next quarters we keep seeing the revenue growth, especially in the government side, sorry, in the commercial side, growing steadily, it is fine. The importance is to have like this balance between revenue growth, free cash flow margin staying above 60%. For the average SaaS is around 40%, called the rule of 30. If Palantir can stay in that range of 60% or more, it means that is actually superior SaaS than the average, because it means it can grow with less resources.
Okay,
And when you can grow with less resources, maybe you can even spend more, so sacrifice some free cash flow margin to grow even more. For SaaS, often you just look at the enterprise sales, the sales, maybe assuming the revenues of the last quarter annualized. So you have an enterprise or market cap to recurring revenues, like annualized recurring revenues. But in reality, it's better to compare that to the growth and the free cash flow. Like you have the EV sales, right? But that compared not only with the growth, as often is done, but compared with the growth plus the free cash flow margin, because these companies always have the trade-off between I spend more in marketing to get more clients, or I expand the margins to get more money, to make shareholders happy.
It's funny that we spoke about Chris and his move to Snowflake, and also what I sent you this morning that David Sachs said in the All In podcast about what he's going to keep on his radar a little more closely about the price to annual recurring revenues, that ratio, because he was saying those got out of whack in the height of what we've seen, which could be called a bubble.
I absolutely agree with that. Despite I was maybe more aware, like I paid more attention, still I realized I didn't pay enough attention to the Fed, to the general multiple, since I just focused more on, okay, I would just want to get a good deal. But for instance, as we saw with the QE in 2020, having a QE is enough to create a huge rally, because basically you have a lot of new liquidity coming into the market. It's like putting more water in the aquarium. With the Fed reducing the balance sheet, basically you have the other way around. So despite it is true that for many businesses things don't change, valuations in aggregate can change a lot.